December, normal day. Markets are open, screens glow green and red, nothing looks broken. Analysts explain volatility. Headlines downplay risk. Everything sounds reasonable, balanced, under control, too controlled, because beneath the surface the numbers are telling a very different story. The same measurements that preceded past collapses are aligning again. Quietly, methodically, not as warnings but as confirmations. Not opinions, not predictions, patterns, structures that repeat whether we notice them or not. This isn't about fear, it's about timing. And timing doesn't wait for permission. Crashes don't begin with panic, they begin with comfort. With the belief that someone else is watching the risk. And when that belief finally breaks, preparation is no longer possible. So ask yourself, if the last collapses followed this same path, why would this one be different? There's a window where risk still feels theoretical, where nothing has broken yet, where denial is still easy, where headlines still sound calm and markets still look orderly. That window is about 18 months, not a decade, not someday, not after the next election or the next rate cut, between mid-2026 and late-2027. That isn't a prediction pulled from instinct or emotion. It's a compression of cycles, debt schedules, and historical timing. When pressure builds for too long, release doesn't wait politely. It doesn't ask for permission. It doesn't arrive gently. It forces its way through. 18 months is the difference between preparation and reaction, between moving deliberately and being shoved forward by panic, between adjusting quietly and being forced to move when everyone else is running for the same exit. This isn't about guessing the exact day. It's about recognizing when conditions can no longer hold. When the system becomes fragile, when the room starts running out of oxygen, because once the clock becomes obvious, it's already expired. Once the countdown is visible, the advantage is gone. And here's the real problem. What if the clock has already started? Crashes don't come out of nowhere. They never have. They're not accidents. They're constructions. Built slowly, layer by layer, while nothing seems wrong. Incentives encourage risk. Debt makes that risk feel painless. Optimism turns warnings into background noise. And denial fills the silence. Think of it like pressure building behind a dam. One extra drop of water doesn't cause the collapse. The collapse happens because the structure was already overstressed long before that final drop arrived. Small cracks form early. They're easy to ignore. They don't change daily life. They don't trigger alarms. They sit quietly, growing wider as pressure builds behind the wall. From the outside, it always looks sudden. Overnight headlines, sharp charts, panic, confusion, blame searching for a single cause. But zoom out, and you see years of quiet strain, years of signals dismissed, years of risk normalized, years where stability was assumed, not tested. Time stretches the illusion. Repetition creates comfort. Familiarity dulls fear. The longer nothing happens, the safer it feels, even as risk quietly compounds beneath the surface. Silence becomes evidence. Calm becomes proof. Waiting feels rational then. And that's the most dangerous part of all. Every collapse looks sudden until you zoom out. History leaves a blueprint, and every major financial collapse follows it almost perfectly. First comes optimism. Asset prices rise, confidence spreads, risk feels justified. Then the warnings appear, subtle at first, inverted signals, rising leverage, small cracks that seem easy to ignore. That's the second stage when the alarms are flashing, but comfort is louder. The third stage is the trigger. Not the cause, just the spark. A failure, a shock, a moment that exposes how fragile the system has become. And the fourth is the cascade, forced selling. Liquidity vanishes. Prices fall not because of fear, but because they have no choice. This pattern doesn't repeat because people are stupid. It repeats because human behavior doesn't change. And here's the part most people miss. The dangerous part isn't the crash. It's the stage before it. In the late 1920s, confidence wasn't just common, it was universal. The stock market was soaring. New technologies were transforming daily life. Radios, automobiles, electricity, productivity was exploding. Wealth felt inevitable. People didn't just invest, they borrowed to invest. Margin debt climbed as ordinary citizens became convinced that prices could only move one way. Warning signs were there. Agricultural prices were already collapsing. Debt was rising faster than income. Credit was tightening quietly in the background. But none of that mattered, because optimism was louder than arithmetic. Leading economists went on record saying the market had reached a permanently high plateau. Then, in October 1929, the illusion shattered. In days, fortunes evaporated. In months, livelihoods vanished. In years, an entire generation learned that certainty is most convincing right before it breaks. The experts were confident right up to the edge. By the late 1992, the story had changed, but the belief was identical. This time, it was the internet. A technology so powerful that it convinced investors the old rules no longer applied. Profit didn't matter. Cash flow didn't matter. What mattered was potential. Eyeballs. Clicks. Growth at any cost. Companies with no earnings were valued higher than companies that had survived for decades. Stock prices detached from reality, floating on narrative alone, and anyone who questioned the math was labeled outdated, too conservative, stuck in the past. This time is different wasn't a warning, it was a slogan. Then, in early 2000, belief met gravity. Prices fell. Confidence cracked. Capital fled. Within 2 years, trillions in value were gone, and an entire generation learned the same lesson again. Because innovation can change the world, but it doesn't cancel arithmetic. What happens when belief replaces value? In the early 2000s, risk didn't disappear, it just changed clothes. Instead of tech stocks, the promise was housing. Real estate only went up. Everyone said it. Banks said it. Borrowers believed it. And leverage made it irresistible. Loans required no proof of income, no assets, no buffer for mistakes. But the risk didn't vanish. It was passed along, sliced apart, repackaged, and sold. Banks didn't hold the danger. They distributed it. Models said it was safe. Ratings said it was sound. Regulators trusted the math they barely understood. One small crack was all it took. When housing prices stopped rising, the entire structure unraveled. Defaults spread, credit froze, institutions collapsed under losses that had been invisible just months earlier. What started as contained became global. And when it was over, the system survived but scarred, which leaves a question still hanging in the air. What if the system never actually healed? Look closely, and the details blur. The decades change, the technologies change, the names change, but the structure stays the same. In every case, prices rose faster than reality. Debt expanded quietly beneath the surface. Warnings appeared early, then more clearly, then unmistakably. And each time, they were dismissed for the same reason. Believing them would have required discomfort. Optimism drowned out caution. Experts explained away risk. Investors trusted the story they wanted to hear. And when the break finally came, it felt sudden only because everyone had trained themselves not to look. This pattern has never failed. Not once. Not because history is cruel, but because behavior is predictable. Which brings us to the only question that matters now. So, where are we in the pattern today? Today's market is larger than ever, older than ever, and more stretched than it appears. The scale alone is unprecedented. Asset prices have grown far faster than the real economy beneath them. This expansion didn't just recover from the last crisis, it kept going, year after year, past the point where cycles usually end, past the point where risk normally resets. But age doesn't kill markets. Conditions do. And the longer an expansion lasts, the more fragile it becomes. Not because time runs out, but because pressure accumulates. Small imbalances that would normally correct early are allowed to grow. Incentives reward risk-taking. Caution gets punished. Stability becomes an assumption. From the outside, everything looks strong. From the inside, the structure is overstressed. And that leads to a dangerous thought. What if this cycle didn't end? What if it simply overstayed? Prices don't have to be wrong forever to be dangerous. They only have to be wrong for long enough. Today, stocks are priced as if everything goes right. Growth without interruption, profits without pressure, stability without shocks. It's like paying luxury prices for a house, assuming it will never need repairs. Not because it's perfect, but because no one wants to imagine the alternative. When prices drift far above what the real economy can support, they don't need a disaster to fall. They only need gravity. A slow pull back toward average, toward normal. That's the part most people miss. Crashes aren't always caused by bad news. Sometimes they're caused by the absence of good news. Because gravity doesn't need a reason. And it doesn't need bad news to pull things back down. Beneath prices, beneath headlines, there's a quieter force doing most of the damage. Debt, not one kind of debt. All of it. Corporate, consumer, government. Layered on top of each other like floors in a building that was never designed to be this tall. For years, cheap money made that weight feel harmless, interest rates were low, payments were manageable, risk felt distant. But debt has a clock. Much of what was borrowed during the era of easy money now has to be rolled over at much higher rates. What once cost a little to service now costs multiples more, And that extra expense doesn't come from nowhere. It comes straight out of earnings, out of cash flow, out of stability. Nothing breaks immediately. At first, margins shrink. Then guidance gets cut. Then layoffs begin quietly. And by the time it shows up in the headlines, the damage is already done. So ask yourself, what happens when yesterday's cheap money finally expires? There's one area of the economy most people don't see anymore. Office buildings with dark floors, empty parking garages, for lease signs that never come down. Commercial real estate doesn't crash loudly. It decays in silence. These buildings were financed at peak prices, when interest rates were near zero and demand looked permanent. Now their values are down, sometimes by half. But the debt remains. Imagine owning a house worth $100 million with a mortgage of $150. You're not just losing money, you're underwater with no way out. Those loans are coming due. And banks don't refinance losses. When borrowers can't pay, defaults don't stay isolated. They move upstream into balance sheets, into capital ratios, into confidence. And that raises a dangerous question. What breaks first, the buildings or the banks? Banks don't operate on cash, they operate on confidence. Most people assume their money is sitting somewhere safe, waiting. It isn't. Banks lend it, multiply it, stretch it. And as long as confidence holds, that system works. But confidence isn't gradual. It's binary. It's either there or it's gone. We've already seen cracks. Recent bank failures weren't random accidents. They were stress tests that exposed how quickly trust can evaporate. Emergency interventions stopped the bleeding, but they didn't heal the wound. They bought time. And time is dangerous in an over-leveraged system. Because if depositors start asking questions at scale, answers stop mattering. Withdrawals accelerate, losses surface, and what looks stable one week becomes insolvent the next. That's how banking crises spread. Not through spreadsheets, but through fear. So consider this carefully. What if the next run isn't stopped in time? Consumers usually break before the economy does. Quietly, invisibly. Credit card balances creep higher. Savings drain faster than expected. Payments get delayed by a week, then a month. Layoffs don't make headlines at first. They happen in batches, in departments, in emails sent late on Fridays. Spending slows, not because people want to save, but because they have to. Restaurants thin out. Big purchases get postponed. Subscriptions get canceled. None of it feels dramatic on its own. But when millions of households do this at the same time, demand collapses. And that's when businesses feel it. Revenues fall. Costs rise. Jobs disappear. The cycle feeds on itself. By the time the data confirms it, the consumer has already cracked. So ask the question most people avoid: what happens when millions cut back at once? At the center of all this sits the Federal Reserve, and it has a problem with no clean exit. If rates are cut too quickly, inflation returns. Prices surge. Trust in the currency erodes. Everyday costs rise faster than wages, and the public feels it immediately. But if rates stay high, the weight of debt becomes unbearable. Companies refinance at higher costs. Defaults spread. Weak links snap. There is no setting that restores balance without pain. So the Fed does what it always does in these moments. It delays, it manages the timeline, it smooths the surface while pressure builds underneath. Rate cuts don't remove the problem, they only change when it becomes visible. This isn't about prevention anymore. It's about sequencing, about deciding which part breaks first and when. And that's the trap. Every move tightens something else, which leads to one unsettling thought. What if delay doesn't reduce the damage? What if it makes the fall worse? The sequence rarely announces itself. It unfolds. First comes denial. Markets stay elevated. Optimism lingers. Weak data gets explained away. Earnings miss, but guidance stays hopeful. Commentators call it a pause, a rotation, a reset. Nothing feels urgent yet. Then the trigger arrives, not because it's special, but because the system is ready to break. A large bankruptcy, a bank under stress, a geopolitical shock. Something snaps confidence. Credit tightens. Prices fall fast 15, 20%, and the selling begins. That's when the cascade starts. Margin calls force liquidation. Funds unwind. Liquidity disappears. Losses accelerate not by choice, but by obligation. Jobs vanish. Spending freezes. Fear spreads faster than logic. And finally, the bottom. Not when hope returns, but when selling is exhausted. The cause won't matter. Only the leverage will. Crashes don't destroy wealth evenly. They redistribute it. When prices fall fast, the unprepared sell to survive. Retirement accounts get liquidated at the worst moment. Long-term plans collapse under short-term pressure. Fear turns paper losses into permanent ones. Panic replaces patience. Time horizons shrink to days, not years. At the same time, something else happens quietly. Those who preserved capital don't panic. They wait. They watch volatility instead of reacting to it. They buy when assets are mispriced, not when headlines feel safe, not when confidence sounds strongest. Wealth doesn't vanish, it changes hands. From the impatient to the patient, from the leverage to the liquid, from those forced to sell to those free to choose. This is why crashes feel unfair, not because everyone loses, but because they don't lose equally. The damage concentrates at the worst possible moment. The transfer happens fast, and it happens without announcement. No warning, no countdown, no ceremony. It doesn't feel like opportunity when it's happening. It feels like survival. And most people are too busy protecting what's left to see what's being handed away. And that leaves one final question hanging. Which side of that transfer are you on now? This is where it comes back to you. Not fear, not panic, awareness. Every collapse in history punished the same mistake, ignoring patterns, because the present felt comfortable. The people who suffered most weren't careless or unintelligent. They were unprepared. They assumed stability would last just a little longer, that there would be time to react. There usually isn't. You don't prepare when the headlines change. You prepare when they still sound reassuring. When risk feels abstract. When acting feels unnecessary. That's why the next 18 months matter. Not to predict the exact day, not to guess the trigger, but to understand the structure you're standing inside. History doesn't send reminders. It doesn't raise its voice. It repeats itself quietly until the lesson becomes unavoidable. This isn't advice. It's observation. A pattern that's played out for more than a century, forming again in plain sight. The window is closing. And history won't warn you again, it already has.